This is Scott Becker with the Becker Private Equity Podcast. We're talking today, October 4th, 2023. And one of the most fascinating things in watching the markets is this concept that the markets surge when there's bad news. And this is one of the fascinating crazinesses of how the market works today. And why is this the case? So the market's up today. The market's up today because wage growth has slowed. So to the extent that people make greater wages is slowing, less inflation and wage growth. This has led the markets to be positive today, since it's another signal that the Fed, and everything goes back to the Fed, doesn't have to be as aggressive in raising rates because wage growth and inflation might be slowing a little bit. This is counter to yesterday when the market got trashed, got killed, down 1.5 percentage points. The Dow was giving up all its gains for the year because there was good news in the labor market. Good news in the labor market yesterday meant that there was an uptick in the amount of open jobs. That meant that it was harder to fill jobs and people would have to pay more and work harder to find employees. This leads the Fed to be more concerned about inflation and leads them to believe that they've got to keep on raising rates. So it's really fast because everything sort of comes back to the Fed and what they're doing with the interest rates. Now, what happens is we're in this incredibly ridiculous cycle where bad news economically is good news for the stock market because it slows down the Fed from raising rates. So today there was bad news. Wage growth has slowed. You've got another news, Citibank starting layoffs, other companies starting layoffs. This is bad news. And this consequently is good news for the stock market. And this is really the perverse world that we're in, that the macro money supply drives so much of what happens in the economics of the stock market versus what's truly good news or truly bad news. So truly good news is that there's lots of jobs open and our kids, our friends, our family can find jobs. That's good news. That's bad news for the stock market because it's perverse, because it means the Fed may raise rates to make that a little tighter and fight inflation. So this is the insane world that we're in, where good news is bad news is good news. Again, today's title, The Market Surge on Some Bad News. Thank you for listening to the Becker Private Equity Podcast. This is helpful in explaining the ridiculousness and the perversity of how our stock market works today, where good news is bad news is good news. It's all driven by what the Fed is going to do. Good news means the Fed may raise rates higher, which is bad news for the stock market. Bad news means the Fed may stop raising rates, which is good news for the stock market. Thank you for listening to the Becker Private Equity Podcast.